PPF, Post Office FD, SSY. Check latest interest rates on small savings schemes. The central government has kept interest rates unchanged on small savings schemes like post office deposits, Public Provident Fund PPF, Sukanya Samriddhi Yojana SSY and National Savings Certificate NSC for the April-June 2025 quarter. As the interest rates on small savings schemes like post office deposits, Public Provident Fund PPF, Sukanya Samriddhi Yojana SSY and National Savings Certificate NSC are revised every quarter, investors keep an eye out on the rate changes. This time, the central government has kept interest rates on such schemes unchanged for the April-June 2025 quarter. The rates of interest on various small savings schemes for the first quarter of FY 202,526 starting from April 1, 2025 and ending on June 30, 2025 shall remain unchanged from those notified for the fourth quarter January 1, 2025 to March 31, 2025 of FY 202,425, according to a Finance Ministry notification. What are small savings schemes? Small savings schemes are savings instruments managed by the government to encourage citizens to save regularly. The small savings schemes have three categories: savings deposits, social security schemes and monthly income plan. Saving deposits include 3 YEAR time deposits and 5 YEAR recurring deposits. These also include saving certificates such as National Savings Certificates NSC and Kisan Vikas Patra KVP. Social security schemes include Public Provident Fund PPF, Sukanya Samriddhi account and Senior Citizens Savings Scheme. The monthly income plan includes the monthly income account. Interest rates on small savings schemes like PPF, Post Office Savings and Term Deposits, NSC and SSY, are reviewed at the end of every quarter and are decided for the next quarter accordingly. The rate review is done on the basis of GSEC yields of the preceding quarter October-December 2024 in the latest case. Latest interest rates on small savings schemes. The interest rates for the current quarter April-June 2025 are as follows: savings deposit 4 per CENT 1 YEAR post office time deposits 6.9 per CENT 2 YEAR post office time deposits 7.0 per CENT 3 YEAR post office time deposits 7.1 per CENT 5 YEAR post office time deposits 7.5 per CENT 5 YEAR recurring deposits 6.7% National Savings Certificate NSC 7.7% Kisan Vikas Patra 7.5% will mature in 115 months. Public Provident Fund 7.1% Sukanya Samriddhi account 8.2% Senior Citizens Savings Scheme 8.2% monthly income account 7.4% per CENT Bank fixed deposits vs post office deposits. Interest rates comparison: post offices are offering FD interest rates between 6.9% and 7.1%, while banks are providing interest rates in the range of 3% or to 8.05% for general public. Senior citizens are offered extra interest rates of fixed deposits. Bandhan Bank offers the highest FD interest rates at 8.05% for 13 tenures of deposits, according to bankbazaar.com. Though interest rates on small savings schemes have been left unchanged for the last 5 quarters now, the RBI MPC is expected to cut interest rates in April monetary policy review for the second time. The government notifies the interest rates on small savings schemes, majorly operated by post offices and banks, every quarter. Nan. Financial changes from April 1, 2025. 12 key changes every Indian must know about. New financial changes from April 1 are going to affect unused UPI numbers, zero balance bank accounts, GST, and income tax slabs. Here are the 12 key financial changes you must know. The financial year 202,526 is set to begin from April 1. With this, a number of financial changes are going to take place, including no income tax up to Rs 12 lakh annual income, unused UPI number to be deactivated, and no dividend if PAN Aadhaar not linked, among others. What are the changes? 1. No income tax on Rs 12 lakh annual income. Tax rebate under Section 87A has been increased from Rs 25,000 to Rs 60,000, with effect from April 1, 2025. This rebate allows for a tax-free income of up to Rs 12 lakh. 2. Unused UPI numbers to be deactivated from April 1. All those UPI numbers that not been used in the past 12 months will be deactivated. Inactive numbers not used for calls, messages, or other services will also be removed. It is necessary to update your banks with your active mobile numbers by March 31.3. No dividend if PAN Aadhaar not linked. It is necessary to link your PAN and Aadhaar by March 31. Starting April 1, no dividend income will be received if your PAN and Aadhaar are not linked. Also, TDS will also increase on dividend capital gains, and no credit in Form 26AS will be available. Point 4. Mutual Fund DMAT KYC. The KYC for mutual funds and DMAT will be done from April 1, 2025. Under this, all nominee details will also be verified again. Point 5. 18 GST on restaurants. Service in hotels offering rooms above Rs 7,500 starting April 1. Hotels charging a room rent above Rs 7,500 a day at any time in any financial year will be considered specified premises, and restaurant services provided inside such premises will attract 18% or GST with input tax credit. Point 6. Minimum maintenance in bank accounts. SBI, PNB, and Canara Bank are going to make it mandatory to keep minimum balance, failing which will attract penalty. 7. Positive pay system for check clearance to enhance security. In order to strengthen security in transactions, a fraud prevention mechanism positive pay system has been announced. Under this mechanism, for any payment above Rs 50,000 via check, the account holder will have to share key details with their bank electronically, including check number, date, amount, and payee name. The bank will verify these details before processing the payment. 8. Priority sector lending. Starting April 1, home loan borrowers can avail up to Rs 50 lock in major cities, Rs 45 lock in mid-sized cities, and Rs 35 lock in smaller towns under priority sector lending. 9. Increase in TDS threshold. Starting April 1, the TDS threshold for various sections has been increased. For senior citizens, the TDS limit on interest income will rise to Rs 1 lock. 10. Upgradation in TCS rules. As of April 1, 2025, TCS rates have changed, affecting foreign travel, investments, and other transactions. Previously, TCS was applicable on amounts exceeding Rs 7 lock, but this limit has now been raised to Rs 10 lock. 11. Extended time limit for updated tax returns. ITRU. The time limit for filing an updated ITR has been extended from 12 months to 48 months. 4 years. If the return is missed for any reason, it can now be updated within 4 years. 12. Changes in ULIP. According to the budget 2025, redemption proceeds from ULIPs that exceed the premium threshold of Rs 2.5 lock will be treated as capital gains and taxed under Section 112A of the Income Tax Act. Nan. Key GST deadlines before March 31, 2025. Know what taxpayers need to complete as the financial year draws to a close. Businesses and taxpayers need to complete crucial GST-related compliances before March 31, 2025, and missing these deadlines could lead to penalties, interest charges, or loss of beneficial schemes. As the financial year draws to a close, businesses and taxpayers need to complete crucial GST-related compliances before March 31, 2025. Missing these deadlines could lead to penalties, interest charges, or loss of beneficial schemes. Raise a checklist of important actions to take on the GST portal before the deadline. 1. Opting for the Composition Scheme. CMP02 taxpayers looking to opt for the Composition Scheme for the financial year 202,526 must file Form CMP02 on the GST portal. The scheme allows small businesses with lower turnover to pay GST at a reduced rate while complying with minimal tax formalities. The last date for submission is March 31, 2025. 2. Declaration for GDA under FCM RCM Annexure VVI Goods Transport Agencies GTAs opting to pay GST under the Forward Charge Mechanism FCM or Reverse Charge Mechanism RCM must submit their declaration through Annexure V or Annexure 6 on the GST portal. The deadline for filing this declaration is also March 31, 2025. 3. Submission of LUT form for zero-rated supplies. Businesses involved in exporting goods or services without paying IGST must file the Letter of Undertaking LUT form for the financial year 202,526 by March 31, 2025. Filing this form ensures that businesses can continue making zero-rated exports from April 1, 2025 without having to pay GST upfront. 4. Rule 42 Annual Recalculation for FI 2024-25 TO avoid interest liabilities. Taxpayers dealing with exempt and taxable supplies must complete their annual recomputation under Rule 42 by April 1, 2025. This process ensures accurate input tax credit ITC calculations and prevents unnecessary tax burdens. 5. Opting in or out of specified premises for restaurant services. Annexure 7, 8 IX restaurants and food service providers operating from specified premises must submit Annexure 7, 8, and 9 to opt in or opt out of this classification before March 31, 2025. This filing is crucial for determining their GST applicability and compliance obligations. 6. Last date for Amnesty Scheme payment. Taxpayers looking to clear pending GST dues under the Amnesty Scheme Section 128A of the CGST Act, 2017 should make their payments before March 31, 2025. The scheme offers interest and penalty waivers for taxpayers who failed to comply with GST laws for the financial years 201,718, 201,819, and 201,920. This is a significant relief for businesses struggling with past liabilities. With the deadline of March 31, 2025, remaining a couple of days, taxpayers should ensure they complete all necessary filings and payments on time. Proactive compliance can help avoid unnecessary penalties, interest costs, and legal complications. Nan. You will get higher salary from April. No key income tax change in FY26 income tax start April 1. Your annual salary up to Rs 12 lakh will become tax-free, and if you earn above that, you will receive a commensurate tax reduction due to revised slabs. As a result, you will receive higher in-hand salary due to lower, read more in a bonanza for salaried individuals. The government announced a significant income tax relaxation in the Union Budget 202,526, to be implemented from April 1, 2025. As part of this, Starting April 1st, your annual salary up to Rs 12 lakh will become tax-free, and if you earn above that, you will receive a commensurate tax reduction due to revised slabs. As a result, your salary is set to increase from April 1st. Hey race, everything you need to know who will get higher salary from April 1st. 2025 The Union Budget 202,526 raised the tax-free income limit to Rs 12 lakh for FY26 via rebate under Section 87A of the Income Tax Act, 1961. Currently, it is Rs 7 lakh for the ongoing FY 2024-25. So, those earning above Rs 7 lakh will receive higher salary starting April 1st due to lower TDS tax deducted at source, as they are the primary beneficiary of the income tax reduction for the financial year 2025-26. Importantly, this income tax relief is available for only those choosing the new tax regime for FY26. However, those earning below Rs 7 lakh will continue to remain out of income tax purview and will not see any impact on their salary. Also, those earning special rate income, like capital gains from the share market, will also not be able to get the benefit on that income. Mainly salaried employees will be the biggest beneficiary of this income tax change from April 1st, 2025. Finance Minister Nirmala Sitharaman in her budget speech 202,526 said, there will be no income tax payable up to income of Rs 12 lakh, i.e. average income of Rs 1 lakh per month other than special rate income such as capital gains under the new regime. This limit will be Rs 12.75 lakh for salaried taxpayers, due to a standard deduction of Rs 75,000. How much will your salary increase from April 1? THOSE earning up to Rs 12 lakh will have to pay no income tax, as compared with Rs 7 lakh currently. Over and above this, there is also a standard deduction of Rs 75,000. It means there will be no income tax on income up to Rs 12.75 lakh in FY 2025-26. So, if you fall in the income group of Rs 7 and 12 lakh, your in-hand salary will increase by up to Rs 6,600 per month, depending upon the salary level, with the Rs 12.75 lakh earners receiving the maximum hike. For those earning above Rs 12 lakh, the revised tax slabs offer significant benefits. 12 lakh 80,000 tax benefit 0 effective tax RATE 16 lakh 50,000 tax benefit 7.5 effective tax RATE 18 lakh 70,000 tax benefit 8.8 effective tax RATE 20 lakh 90,000 tax benefit 10 effective tax RATE 25 lakh 1,10,000 tax benefit 13.2 effective tax RATE 50 lakh 1,10,000 tax benefit 21.6 effective tax rate. Marginal relief for those earning marginally above Rs 12 lakh according to the CBDT. In the new regime under Section 115 BAC 1A, marginal relief is available to resident individuals who have income marginally above Rs 12 lakh. For instance, for a person having income of Rs 12,10,000 after excluding standard deduction, in the absence of marginal relief, the tax works out to be Rs 61,505 percenter of Rs 4 lakh 10 percenter of 4 lakh and 15 percenter of Rs 10,000. However, due to marginal relief, the amount of tax to be actually paid is Rs 10,000. Income tax slabs for FY26 new vs old regime. Under the new regime, the income tax slabs announced in the latest Union Budget 202,526 arena, and importantly, those earning up to Rs 12.75 lakh a year including a standard deduction of Rs 75,000 will have to pay zero tax during FY 25-26. Under the old regime, income tax rates continue to remain the same, and for senior citizens aged 6,080 years, the basic exemption limit is Rs 3,00,000. For super senior citizens above 80 years, it is Rs 5,00,000. The old tax regime allows deductions under various sections, such as Section 80C up to Rs 1,50,000 for investments like PPF, ELSS, and LIC premiums. Section 80D health insurance premiums. Section 24B interest on home loan up to Rs 2,00,000. Other exemptions like HRA and LTA. Nan.